get into what's happening around the country, the continent, and our counterparts in New Zealand. We like to keep an eye on what they're doing because we do have some members who do tune in from New Zealand as well. But let's have a crack. Now, this is an interesting report for you today. Housing downturn reverses in February, with Melbourne and Hobart leading the way. So CoreLogic is who we get our notes from and who we follow. National Home Value Index posted a 0.3% rise in February, breaking the short and shallow downturn that lasted just 3 months and dragging the national measure of home values down 0.4%. The February rise was subtle but broad-based, with every capital and rest of state region except Darwin and regional Victoria recording monthly rises in values. So the month also marked the start of what could be an inflection in growth trends. So obviously this is a response to the interest rate decrease, but cannot be directly related because it wouldn't have taken effect. So it's amazing what sentiment can do. But let's look further. Melbourne and Hobart led monthly gains. The largest month-on-month change across the capital was recorded in Melbourne and Hobart, both up 0.4%. Not massive, but up, where home values have previously been among the weakest. For Melbourne, the lift breaks a streak of 10 consecutive months falling. Melbourne has had a falling property market for 10 months, and they've rebounded by 0.4%. Conversely, the mid-sized capital of Brisbane, Perth, and Adelaide have lost their mantle at the top of the pile as strongest growth, with a monthly change of 2.2 and 0.3. The mid-sized capitals were outpaced by Melbourne and Hobart being 0.4. Adelaide and Brisbane are still leading rolling quarter growth trends, up 1.2 and 0.9. But Perth's value growth has slowed more sharply, with downward revisions over recent months dragging the quarterly change to just 0.3. We'll talk more about Perth, so don't panic, Perthians. The return to growth across Sydney and Melbourne is being driven by the more expensive end of the market, with upper quartile house values leading the monthly gains in both cities and high value markets, recording sharpest declines. This stronger performance in line with earlier research from CoreLogic, which highlighted the premium housing markets in Sydney and Melbourne have historically been the most sensitive to rate cuts. So Mr. Tim Lawson said the improved housing conditions have more to do with the improved sentiment than the immediate improved borrowing capacity, as mentioned previously. Expectations of lower interest rates, which solidify in February, look to be flowing through to improve the confidence in buyers. Along with a modest rise in values, we have also seen an improvement in auction clearance rates. Remember those, Perth? Auctions? Which have risen back to around a long-run average across the major auction markets. Regional housing conditions continue to show a stronger growth trend relative to the capital city counterparts in February, with values across the combined regional index rising 0.4 over the month and 1% over the rolling quarter, compared to the 0.3 monthly rise and negative 0.4 quarterly rise seen in capital city values. However, there has been some diversity in these trends, with the monthly change favoring Sydney, Melbourne, and Hobart over their regional counterparts. Improved market conditions may also be supported by a slowdown in flow of fresh advertised listings for sale. So nationwide stock is once again a problem. So counts of new listings coming to market across the combined capitals were tracking negative 4.5, so nearly 5% below the previous 5-year average. So considerably lower. although total advertised supply levels are almost 1% higher than a year ago. So we're not talking catastrophic shortages like we did 12 months ago. So yeah, below previous 5-year average, especially the buyers are coming more active and higher sentiment lower. So let's have a look at what's actually happened. Sydney in the month, 0.3 growth, which we said. Quarter, negative 0.9. Annual, 1.1 for Sydney. That's the 12 months. That's what they've had growth. Melbourne, 0.4 growth, which was a shock to most. 1.1, a negative 1.1 for the quarter, and still negative 0.32 for the year. Brisbane, 0.2, 0.9, and 9.7 growth. Adelaide, 0.3, 1.2, 11.9. Perth still leading the charge with a 0.3 growth for the month. And 0.3 for the quarter, but leading the charge overall with a 14.3 growth annually the last 12 months. Combined capital cities, 0.3, negative 0.4, 3.2. And the national report is 0.3 growth, negative 0.1 for the quarter. So very close to a flat line for the quarter, and a modest 3.8% growth annually, or the last 12 months, when I say annually, for the whole of Australia. Let's look at the rental market, because that's interesting as well. So national rents rose by 0.6% in February, the strongest monthly gain since May last year, but well below the 0.9 rise recorded in February last year, or the 1.2% gain seen in February 2021. Obviously, February reporting on property management is seasonal, because we have such a terrific January with a lot of movement. So we can reflect on our February's previous years. So it wasn't as strong as the previous two. Rental trends are highly seasonal, and the pickup in rental growth through the first quarter is likely driven by these seasonal phenomenons. The broader trend points to a slowdown in rental growth as households become larger and net overseas migration normalizes. The annual trend is more indicative of the slowdown in rental growth. National rents rose by 4.1% over the 12 months to February, the slowest annual gain since the 12-month ending March 2021. Despite the slowdown, the annual change in rents is tracking about double the pre-pandemic decade average of 2%. Let's read that again. Nationally, rents rose by 4.1%, which is double, okay, the annual change in rents prior to the pandemic, which was 2%. So that's quite interesting. Let's look at the gross rental yields have lifted a little over rental months. So return on investment, so you can share with your investor clients, rising from a recent low of 3.65 nationally to 3.72 nationally. This is the result of rents rising at a faster pace than housing values since the value trends found peak in October last year. Obviously, where you're only getting 3.6 and 3.7% return on investment, you are definitely eligible, or should I say, opportunistically better off with capital growth. In opposition to some of the rural areas like, the Pilbara, and of course, mining towns and regional areas where you'll get a better return on investment, but you'll get a lesser opportunity for capital gain. So that might be something you want to just keep in your hats when you're dealing with your investor clients. And we've got a great array with Crawford Realty, We've got First National in Albany. We've got Kevin Green in Mandurah. What other regional? We've got Kwinana, who's performing amazingly, which is Encore Property. These are the people that you want to be talking to if your investor clients are looking for the more 5 to 6, and even up to 10 plus in the regional areas, especially mining. There's a little plug for you guys, Crawfords, and obviously our regional members. And if you want to talk to them, feel free to do so. So what else can we look at quickly with regards to why and what's happening? So the rise in demand for housing from lower interest rates and a sentiment boost will be partially offset by slower population growth. We already mentioned that. Low levels of newly built housing should also deliver some support to housing values in 2025. We know that Australia has a shortage of homes. And until they build these 2 million homes that they're talking about, and they are slowly coming through, but not quick enough, we will continue to have these strained, sort of stock levels. And supply and demand is what drives the market. So low supply, high demand. High demand, low supply. But nothing in there, folks, has indicated huge growth forecast, price growth forecast. In my opinion, that is. So you might see a few percent rises, but I don't see, because it was January, lots of movement happening in January. We're now through February. Sorry, those are the February reports. So we've moved through January, February. So very seasonally busy real estate months. So I'm not surprised we've seen a little lift, because generally it was a flat line before that. So it didn't take much for the lift. I'm not playing the market down, because I know it's still very, very good. And I'll explain again my opinion on that. But we're not seeing a boom. So what I'm saying is, when you're talking to your sellers, your landlords, I'm not saying play the market down, but I'm saying that if you start over promising, you're making your jobs a lot harder. So we are still in a changing market. So be mindful. Just so that you're aware as well, that 3 months considers a trend, not one. And now we've got a month slight improvement in the national, and that's based really on Melbourne. Now, Melbourne has been flat as a pancake for 10 months. So what goes down must come up, and what goes up must come down. So reading between the lines there, it's still correcting itself with the changing market. But Melbourne, like I said 3-6 months ago, would have been a great place to buy. Now if you want to buy, you better rush and buy there or New Zealand, because they've had their somewhat downturn. And I'm talking significant, like probably 15%. So you'll pick up 15%, but I've looked at those regions and areas, and the prices are still very, very high. So nothing's a bargain these days. Those days are gone. All right, let me carry on. Okay, let's look at quickly New Zealand. We'll just have a quick look at them. So New Zealand property values returned into a growth stage as well, which I think is really good, because they've had like 2 years of downturn. Property values in New Zealand rose by moderate 0.3% in February. The clearest sign yet that 2024's mini downturn has come to an end, and that 2025 will likely be a modest growth. The median national value now stands at 807, which is down 16.9 from the record highs. There you go. In late 2021 and early 2022, but still positive 17% above pre-COVID figures of 689,353 in March. So They had over 30% growth, and they've lost 17% of it, or 30 odd percent. This is a very good market to keep your eye on because we tend to follow them because they are a micro market, similar to Perth, whereas the whole of Australia is more of a macro market, being over 25 million people. These micro markets, especially ones like New Zealand, which they used to follow us, but we tend to now follow them. Maybe that's because Lord of the Rings or something like that. I don't know. Okay, let's have a look at Perth. Perth. I'm getting a picture taken. Did you take the screen here?
Yes. Take it mine.
So it's a lot here.
Yeah, well, it's only mine.
Perth weekly snapshot. Only 869 sales reported last week, which is not fierce. Above 1,000 is fierce. So it's down 19% from the previous week. Although we have tipped down again, below the 5,000 properties, which is still significantly low. We know this, with 4,969 properties available in Perth. There's 2,087 properties available in Perth for rent, which is also low, with I think only 551 properties leased last week, which again is not super high compared to January and February. So yeah, there is a lot going on, but nothing that is out of kilter, so to speak. Let's see if there's everything I've mentioned there. So okay, let's talk about my opinion, as I always throw in the mix, and I'm not often wrong, but I'm right sometimes. Okay, so let me give you my snapshot, and I think I've mentioned this before, and it hasn't really changed. Because I see at least 20 salespeople in a month. In fact, I've got 20 personal coaching clients, probably more, because some see me once a month. But I've got over 20 personal coaching clients that I sit with and talk about their market, what they're doing, what their activity's like, and how much the market is moving and changing. And so I get it, and I read the reports, property reports across the country all the time, and stay abreast with it. So it's simply that I'm probably more over it than most, and also having been in the property game for nearly 25 years, I'm able to spot trends and I suppose be instinctual about the market. What I am seeing, which is no different from probably what I told you last month, is that the market's definitely changed here in Perth, but properties are still selling, and we're still getting good numbers through home opens. We just don't have the same panic as we had 12 months ago, where people would have bought anything at any price. And one of the reasons for that is this. The panic buyers are people who need to buy and will pay anything because they need a home over their heads. The not so panic buyers, mums and dads, families, upsizers, downsizers, retirees, and the normal movers in the market could not move 12 months ago because there was no stock. So they froze. Okay, they were like deers in the headlights. So one of the biggest objections we had in the last 24 months or so was, my sellers don't want to move because they've got nowhere to go. What do I do, Ryan? And I gave lots of different scenarios there, but of course, some just wouldn't do it. Those are your movers now. People are moving because there's a little bit more stock. Days on market. I had a property which we sold. It took 3 weeks to sell. I did not think it would take 3 weeks to sell, and we didn't get as much as what we were hoping for it. And that's just life. So it wasn't awful, but it wasn't certainly pop the champagne stuff. And we found that every buyer was sensitive, and the finances that were coming through were were stretched. This was particularly a first home buyer investor area. So it didn't give you a complete snapshot of the market, but it did give us, because we sold 7 properties last year and they got snapped up very, very quickly at very, very good prices. So that in itself is an indication. So there is a lot of movements in Perth at the moment. There's a lot of sales happening in Perth. So you will do very well this year. There's a lot of changeover. I think the property management market has seen a few more properties come to market. I think the vacancy rate has increased to about 2%, which is still not high, but it's double what it was. So we are seeing an ease in the market, and all those signs are there, where people are shopping around and being a little bit more cautious in their buying and are not just increasing their offers outrageously to secure the property. But that can change at any time, in one way and one way only, and that is stock levels. So stock levels drop, our demand increases, and it could get into a panic situation. From the clients that I'm talking to, stock levels have dried up again. So yes, stock is always hard to come by, and it has been always hard to come by in 25 years of real estate that I've been in here. We're a micro market, and there's a shortage of housing. So there will be shortages, but it's not. It's increased, and it's kind of plateaued on that increase that hasn't dropped significantly down to what 3,000, which it was. So we've got more stock. It's still not great, but the movement at the moment is people who've been waiting to move. So I call it the pent-up movers. The people who didn't move 12, 24 months ago, who now go, okay, there's stock out there. Let me go and have a look. Yes, there's stock. Right, Mr. Agent, come and list my property, and we can now start looking for a property. And the double whammies, the what we call the leapfrogs, the subject sales are out there. So subject sales are the bomb at the moment. Look after your people. Get back to, all right, subject sale. Your paperwork has got to be spot on. You've got to make sure that you're abreast of all that stuff, because we haven't had to do a lot of subject sale stuff. You've got to get abreast of people are more likely to take bridging finance now and stuff like that. So the market's changed. We've got to upskill, and we've got to just refresh our skills on this market that is a bit more of a moving market, meaning people are listing their properties and buying. They're not just buying in panic. Now, how long will this last is the big question. And that depends on what happens between now and winter, because we know that less stock comes to market in winter, and not necessarily less sales happen, although there is a little bit less sales happen, but not massively. So we could see, if stock levels continue to stay at that 5,000 or below, and then we go into a winter, we could see that come down to 4,500 properties, which will swing us back into an upturn or a price increase. If not, if stock continues, if stock between now and, let's say, June continue to increase, then it's likely we will swing into a slower 2025 than expected. But all the indications and signs are there that it's going to continue at least for 2025. I was talking to a gun agent that does about 5 million, and we're going to try get him to speak in a couple of months' time. He's coming to see me. And I was just saying to him that this is probably the year for you guys. Make hay while the sun shines. Affordability is becoming a problem if it pushes much higher. Obviously, we know that immigration has slowed, and there's a lot going on around the world, which is starting to have a an effect on people's decision-making process. So we all know what that means. So I'm not going to go into that. And that's it from the horse's mouth.